Arguably, all investment does involve risk. The risk of losing your stake, your original money, your original investment money. Therefore, each time you invest, you expect to receive a risk premium, which is a return on your money which is greater in excess than the original amount of money that you invested. This extra amount acts as a compensation for the risk that you have taken. Attempts are made at measuring risk and relate to variance, which is a measure of volatility in relation to the risk, and standard deviation, an attempt to measure the likely range of volatility. For example, if the range of volatility appears to be 21%, then that may mean that it's a medium high risk, as you could gain 21% on your money, or indeed you might lose 21% of your investment, according to the measurement that you have taken. However, if the range of volatility is 9.5%, then this may seem to be a much more acceptable risk to you, as it is a medium low risk, where although you might only gain an increase in 9.5% in your money, you might alternatively only lose 9.5% of your original stake money. There are different considerations to risk. For example, investing in companies where businesses are highly seasonal, such as companies that make umbrellas or produce ice cream. Also, investing in service companies whose assets are intangible, rather than companies that may manufacture products which are tangible, visible assets. Also, investing in online companies which have no physical presence, as opposed to investing in more traditional companies which own bricks and mortar offices and factories. It is often a good policy to consider investing in an organisation that produces and owns a whole range or portfolio of products. Then, when some are selling less well in the market, others are performing better than before. So this offsets the underperforming product in terms of sales and profitability. And an alternative policy to consider is investing in a multinational organisation. Then, when the company is performing less well in one region of the world, it is doing better than expected in a different region of the world. Again, this success offsets sales and profits in the underperforming region. Then there is the capital asset pricing model. This is only a theory, but it's very useful, and it's concerning the relationship between risk and return. And it states that the expected risk premium equals its beta times the market risk premium. Beta, this is the sensitivity of a stock's return to the return on the market portfolio. So the equation is this: the expected risk premium equals beta, which is, I've just said, the sensitivity of a stock's return to the market in relation to the market portfolio, times the market's risk premium. Obviously, some markets are riskier than others. Also, some companies in a market are riskier than others. In considering risk, you need to look at the macro factors surrounding a company, such as the social, legal, economic, political, and technological factors. Then you need to look at the internal micro factors within the company, such as its experience, knowledge, its reputation, its capabilities, its competencies. Then you need to consider the type of industry in which it operates. So does it provide gas or electricity? Does it manufacture foodstuffs for humans or for animals? These industries generally tend to be seen as less risky. However, if the company drills for oil and then refines it into petrol, or it is an airline company, these industries are usually regarded as being of much more high risk. There are external organisations that produce market indices to provide investment performance data. For example, the Dow Jones Industrial Average. This provides an index of the investment performance of a portfolio of 30 leading blue chip companies and how their stock or their shares are performing. And there is the Standard & Poor's Composite Index, which measures the performance of 500 large organisations. Standard & Poor also provide credit ratings for countries. The larger organisations tend to develop long-term plans for growth. For example, a large pharmaceutical company might want to develop a new drug, which they estimate will take 10 or 12 or even 15 years to come to market. They will need to consider the capital budgeting of the project, how it's going to be funded, and the relative risk of the project. Is it likely to be successful or not? And if so, how successful? A large pharmaceutical company is likely to be a PLC with investors or shareholders, and it is likely to be a multinational organisation. So this company, can this company actually fund the project, either from its current earnings or from existing borrowing arrangements, or will it need to raise additional finance? For example, it could approach existing shareholders and offer them the opportunity to purchase additional shares, or it could allow the opportunity for new investors to buy shares, or if a large tranche of shares will be made available, it is likely that the company will offer a combination of the two, partly to existing shareholders, partly to new shareholders. However, what these investors will need to know is that they may employ financial advisors to help them on whether they should or whether they should not buy these shares when they become available. So we need to consider some further things. One is the company cost of capital, and that is the rate of return that investors can expect from the company and from their investment. This can be determined to a great extent by the average risk of the company's assets and operations. And then to consider the project cost of capital, the likely minimum expected rate of return on this particular project given its risk, that will be acceptable to these potential investors. Also to remember is that there are actually two costs of debt finance. One is the explicit cost of debt. It's the rate of interest that bondholders or stakeholders or shareholders will demand. And two will be the implicit cost. This is due to the fact that the borrowing does increase the required return on equity. Now we need to consider the cost of capital. The company or the organisation has to consider the cost of capital. This is calculated as a weighted average of the returns which are demanded by debt and by equity investors. In effect, it is the expected rate of return that investors would be likely to demand across a portfolio of all of the firm's outstanding securities. If the rate of return is deemed to be inadequate, then shareholders can do several things. They can complain, they can call an extraordinary general meeting of the directors, they can oust those directors who hold official office, and they can do this by having a vote. And then they can vote in replacement personnel to replace those directors in their capacities, in their particular roles on the board of directors. So it is this collective power that shareholders in a PLC do have. Also, the cost of capital only depends upon the interest rates and the risk of the project itself. This means that all costs associated with floating shares on the stock market should be treated as negative cash flows. This is due to the fact that they do not increase the required rate of return. So, we need to look at financing. Business requires financial funding. It is this that does allow a business to expand. For example, the Ford Motor Company. They may want to build a new factory in Southeast Asia. So, will the company utilise reserves of cash from past profits? Will it borrow cash from a bank? Will it issue shares to investors? Will it issue a bond to long-term investors? All of these options exist, and companies could decide to take any one of them, or it could decide, of course, to utilise a combination of them. It should be remembered, though, that investors are looking to identify efficient capital markets in which to invest. An efficient capital market is a financial market in which the security prices rapidly reflect all of the relevant information about the asset values of the investment. This is, of course, based upon the information that is currently available to investors. it could be considered as the current true value. It is not therefore the ultimate future value. It is this situation here regarding the future where the innate skill and judgment of the successful investor plays its part. It is true to say that luck can play a part, but of course luck cannot be sustained over time. So only those investors who have studied a particular market in some depth and have an instinct regarding the likely future consequences of change will remain successful over an extended period of time. So, corporate finance. Large organisations use several different types of securities. For example, the Mobil Oil Company. This company attracts investment from several different sources, such as 1. Equity, common stock, or preferred stock, shares. 2. Long-term debt. And the Mobil Oil long-term debt involves such as debentures, industrial revenue bonds, notes, floating rate notes, Japanese yen loans, sterling euro bonds, Canadian dollar euro bonds, and ECU euro bonds, together with Swiss franc notes. So you can see the Mobil Oil Company has approximately 185,000 investors in total, and it raises money from a variety of different sources. So Mobil Oil is financed through several different bonds all being utilised at one and the same time. And the standing of bonds are given ratings by a company known as Moody's Investment Ratings. According to Moody's, there are 9 levels of rating that are given, from AAA, which is judged to be of the best quality standard, through to C, which is the lowest rated class of bonds. The top 4 levels of bond range from best quality to medium grade. However, the 5 lower levels of bond are often referred to as junk bonds, which denotes they are of a poorer standing. So in essence, this means that they may be highly speculative or risky, and may even mean they are unlikely to ever attain any real investment standing at all. I need to mention venture capital. This is money that is invested to help finance in the launch of a new product. And there are organisations which exist solely for this purpose, known as venture capitalists. They will see a proposed business plan, and if it is satisfactory to them, will invest a considerable amount of money in this new venture. However, they'll need an expectation and agreed expectation to pay back their original investment plus an agreed additional sum of money by a pre-agreed set date. This could, for example, be 3 years later or 5 years later, and it could be seen therefore as a long-term investment. Also, they will insist on representation on the board of directors, usually of 1 or 2 of their personnel. The main purposes of this being that 1, they will have an input in the decision-making process of the organisation in its infancy, in its early days, and 2, that the person or the people who they place on the board will not only have experience of business, but will also possess particular expertise which the venture capitalist has identified is lacking amongst the other current board members. Obviously, when an organisation initially sets up and offers shares for the first time, which is called an IPO, an initial public offering, there will be those investors who are only interested in a short-term gain. They will purchase shares, and on the very first day that these shares are traded on the stock market, will be watching to see the share price going up. Assuming that this does happen, they will then issue an instruction for all of their shares to be sold, leaving them with a profit within a single day of trading. This does, of course, signify that they have no sentimental attachment to that business whatsoever.